To begin with, we're going to review study habits and a general approach for what you want to do to pass this exam. First of all, you're going to need to buy all these books. It's about 12 books you need to buy. You need to be familiar with all of them. It's a pretty daunting task. There's probably over 2,000 pages here. So you need to be familiar with these books and know how to look things up in them. One thing you want to do is buy some bookends or make yourself a book rack to take with you to the exam so that all your books are set up and they're not stacked sideways. If they're stacked sideways, they're going to be falling off your desk. You want to set everything up just the way you're going to be at the exams. Some other things you want to buy is architects or engineers rulers. This, the 32nd scale, even though the plans on the second day are not to scale, the 32nd scale comes close. Secondly, you want a number of mechanical pencils. If you get regular pencils that you have to sharpen, you'll be standing in line with 50 other people waiting to sharpen your pencil. Another thing that's good to have is these are called Japanese erasers. If you mark the wrong thing or for some reason mark the wrong circles, you've got to erase them very cleanly. Otherwise, it'll mess up your exam. Then you need, for the first day of the exam, you need a financial calculator. What you've got to have is one that does loan calculations that you can learn how to use. It'll save you a good amount of time. Secondly, you want to bring a second set of batteries. You're only allowed to use whatever you put on your desk when you start the day. You're not allowed to go back down into your box full of stuff and pull anything else out. Day two, you want to pick up one of these. You can buy them on eBay for about $39, or you can go to Home Depot and pick one up. You can solve 10 to 20% of the problems in less than 1 minute. So these are good investments to make, and you understand, okay, I'm ready to take this exam. The contractor's exam is divided into 2 days. The tests are 9 hours a day. Okay? Most people have never taken 2 9-hour tests back to back in their life. You know, that's just extraordinary. And so what I've done is divided the exam into these 2 days. And we're going to review first day 1 of the exam. Everything you need to know is going to be summarized. The information I give you, as much as possible, you need to become familiar with it, memorize it, and know this stuff. Then secondly, you have to be able to find obscure questions and listings that they're going to come up with. You've got to be able to look them up in these books. You're going to have all the books with you on the exam. Okay, so right now we're going to cover accounting, and then we're going to cover the entire first day. We do accounting, contract law, lien law review, Florida Statutes Chapter 489, which covers contractors, Circular E tax guide, which is your federal tax, and that's pretty much day 1. First thing we're going to cover is accounting. The book they give you for the Florida Contractors exam is the Builder's Guide to Accounting. This is not an introduction to accounting. This is applied accounting. It asks, how are you going to take a number of normal accounting conventions and how are you going to apply them to construction? Okay? So the first thing you need to learn is accounting. You have to learn the basics of accounting. All right? If you haven't had accounting classes, we're going to have to go through it and review it until you get the big picture of what accounting's all about. Once we get the big picture of what accounting's all about, then we can go in and answer the questions that they ask in this book, The Builder's Guide to Accounting. How are you going to use these accounting conventions in your construction company? Okay, that's what this book is all about. That's what the accounting review is all about. Number 1, accounting review, you have a chart of accounts. This is a catalog of all sources and uses of funds. Types of accounts are assets, liabilities, and net worth, or equity. Okay, what you need to understand about this is assets are things, liability and net worth represent ownership of those things. The classic accounting equation is assets equals liabilities plus net worth. Assets are things of value, Liabilities and net worth reflect ownership of those things. There are debits and credits. You need to understand the concept of debits and credit. All debit means is left. All credit means is right. It doesn't mean plus or minus, positive or negative. In an asset account, a debit is a positive and a credit is a negative. In a liability and equity account, a debit is a negative and a credit is a positive. There are things called contra accounts or balancing accounts. You don't need to know about them to pass this exam. In accounting, we have debits and credits. Debit means left, credit means right, okay? In an asset account, a debit is a positive and a credit is a negative. In a liability or equity account, a debit is a negative and a credit is a positive, okay? These are balancing. These are like a mirror image of one another, okay? And that's how accounting balances out. We have primary financial statements. These are the balance sheet, the income statement, and the sources and uses of funds statement. You need to understand these and know how to work with them for the exam. The balance sheet is an excellent representation of the accounting equation, which is assets equal liabilities plus net worth. The balance sheet is divided into these three accounts. They have assets, which have debits and credits, liabilities and net worth, which are on the other side of the balance sheet. And we'll show you a slide of that. So what we have is things and ownership of things. That's the way the balance sheet is laid out. You have assets, which are things of value, and then you have ownership of those things, which are liabilities and net worth. Okay, the income statement. The income statement is a snapshot of a business on a given day and time. The income statement can also be called a profit and loss statement or a summary of operations. On the exam, typically they won't call it an income statement. They'll call it something like a summary of operations. So you have to figure out what they're talking about. The income statement is divided into a number of accounts, and the best way to understand an income statement, you start out with earned income, and then you minus your returns, and that equals net sales. Then you minus your cost of goods sold, and that equals gross profit. Then you minus your selling expenses, and that equals profit before fixed expenses. Then you minus or subtract your fixed expenses, and you come out with net income. On the exam, what they're going to do is give you a bunch of numbers from these categories, and then ask you to solve an equation. For example, what is your profit before fixed expenses? And then they would list additional expenses that you don't need to deduct. So they try to make it a little tricky for you. So it's very important that you understand this concept of going, all right, earned income is a plus, and then you subtract out all these other categories such as returns, cost of goods sold, selling expenses, fixed expenses. You're subtracting those all out from your gross income. And again, they might call your first earned income, they might call it something else to try to trick you. They might call it gross sales, they might call it net sales, they might even call it total charge sales. But if that's the only gross income figure they've given you, that's got to equate to your earned income. The next one, sources and uses of funds statement. This summarizes the management of cash during a specified period. It's also called a statement of cash flows. According to the Builder's Guide to Accounting, they say, in many ways, this is the most valuable report because it tells you how and where cash is being obtained and spent. So for the purposes of the exam, in many ways, the sources and uses of funds statement is considered the most valuable. If you're auditing someone's books, the sources and uses of funds is amazing what you can find out about a company. You take these 2 years' books and you can figure out where they're getting their money from and where they're spending it. So you can calculate whether they're actually making a profit or whether they're selling off assets to make their business look good, or if they're just making up numbers, because the numbers have to match from one year to another. And people who are making up numbers, they won't think about that. And so you can go back and subtract the previous years, and if the numbers don't match up, somebody's making up numbers. So that's why in many ways the sources and uses of funds statement is very important for auditing. For the exam, they're basically going to ask you a few questions about it. That's it. You don't need to know it. For being a contractor, you'll probably never use sources and uses of funds statement. Managing assets. Since assets are things, they can and must be managed. The Builder's Guide to Accounting details choices for managing these assets. Basically, this book asks you, you've got all these things that are of value. Money, cars, trucks, materials, all these things have a value. And then they ask you, how are you going to manage them? What are you going to do to make sure that each of these categories are helping you stay in business? Okay? And you have some choices. So we look at the balance sheet. All of these assets accounts must be managed if your business is going to be successful. Some of the asset accounts we have are current assets, petty cash fund, the cash in banks, notes receivable, accounts receivable, reserve for bad debt, retainage, inventories, long-term assets, land, buildings, furniture expenses, autos and trucks, equipment, machinery, small tools. Every one of these areas you can manage it, such as your petty cash fund. If you have $300 in there and you keep losing $100 a week, doesn't show up, it's important to manage that. Cash in the bank. If you move that into a money market account, you can pick up 3, 4, 5% interest. At the end of the year, that can make a difference. Your notes receivable, money that people owe you, you've got to stay on top of it and make sure you collect that money. Reserve for bad debts. You also have to figure how much of this stuff are you never going to get paid for. If you take credit, some percentage of the people you extend credit to are never going to pay you. And so you don't want to count on collecting all the money when it's never going to come in. So you're going to set aside a certain amount of your credit sales and say 5%. We're going to assume that that 5% is never going to come true, okay? And then retainage. When you're doing a job, typically you put 10% aside. That it's a holdback to make sure you finish the job properly. And so your job may be for $100,000, but maybe they only pay you $90,000 and you get the last $10,000 when the job's completely finished, when you have your certificate of occupancy, okay? So if you think you're going to have $100,000 to work from and you haven't taken this retainage out of your accounts, you're going to come up short. You're going to run out of money. So it's very important that you manage each one of these asset categories, such as inventories. A lot of people have old materials laying around and they will list them on their balance sheet and their income statement as assets because it looks good. But in reality, you may not ever use these old materials and inventory you have laying around. And so you have to be sort of realistic about it. You have land, that maybe you buy land and you think you're going to develop it. You have to keep an eye on, is the value going up or down? You have certain expenses in maintaining the land. Buildings, same thing, you have to maintain your buildings. Your autos and trucks have to be maintained, equipment, machinery, and you have to make decisions. Is it less expensive to lease a piece of machinery? Is it less expensive to rent it? Pay them top dollar, rent it for 5 days, and then you don't use it for the rest of the year. And so you have to go through all these different decisions and figure out what costs you the least money and what saves you the most money. And that's what the income statement does for you, is helps you analyze those decisions. Ratio analysis. Ratios are a quick and short way to understand how a business is being operated. You can look at a ratio and know absolutely nothing about a business and figure out how it's being managed. Ratios allow you to compare one company to another company. Ratios allow bankers and investors to compare your company to the industry standard. They do this by getting a SIC code or a standard industrial code published by Standard & Poor's. And they match your income and expense categories to the industry standard, which is calculated from taking maybe 100 or 200 tax returns and averaging them. And they will have complete averages for whatever type of business you're working in. So if you build townhouses, there's a SIC code for townhouses. And there's a profit and loss statement just for people who build townhouses. If you build bridges, there's one just for that. Okay? So you can go there, pick out the Standard & Poor's industry standards, and check your business against the standard. And it's important that you know that, because that's what the bankers are going to be doing when you go in and show them that you want to build something and you show them your company and all. They're going to be checking, they're going to be comparing your company to the industry standard. You can go to the library, look this up, make a photocopy of the page that relates to your type of business. Okay, we have some examples of ratios, and let us say a quick ratio. You can use a quick ratio, and without knowing anything about a company, you can tell that one company is doing better than another. For example, here we have company A has a 1-to-1 ratio, company B has 2-to-1, and company C has 3-to-1. What this tells us is that company C is managing their cash assets better than company A. They have 3 times as much cash on hand as they have debts every month. Now company A has 1-to-1. In other words, they have just enough cash to pay their debts every month. That's a tight position. And so without knowing anything about these companies, we can tell how well they're being managed and how close they are to going broke. Now, what we don't know by looking at this is company A that has a 1-to-1 ratio could be General Motors, worth billions and billions of dollars. Company C could be Ace Hardware Store, you know, your local Ace Hardware Store, worth a couple $100,000. But by just looking at the quick ratio, we can tell how well they're being managed and how well they can pay their bills or any unexpected problems that come up. The next ratio is the current ratio. Current ratios are assets divided by current liabilities. The current assets, cash, receivables, and inventories are compared to current liabilities, which are current notes payable, accounts payable, and accrued taxes. A good current ratio is 2-to-1 or higher. That's a question they typically ask on the exam. What's a good ratio? Or they will give you an example of a weak ratio and say, this company has a current ratio of 1-to-1. Is that acceptable? Is it good? Blah, blah, blah. And the answer is a ratio of 1-to-1 is weak, not acceptable. A ratio of 2-to-1 or higher is considered acceptable. The shorthand ratio analysis allows bankers to understand a business without knowing anything about that business. That's why they're so widely used. The quick ratio or acid test assumes that a lot of people have inventories that are never going to turn into cash. And so what they do is they take current assets, they deduct inventories out of those assets, and then they divide it by current liabilities. This compares current assets with no inventories to your current liabilities. An acceptable ratio for your quick ratio or your acid test is 1-to-1, while your current ratio was 2-to-1. The acid test calculates the ability of the business to pay its bills every month. Here's how ratios are calculated. There are 3 types of ratios. One type come the income statement ratios. Both parts of the ratio come off your income statement. The balance sheet ratios, both parts of your ratio come off the balance sheet. Then when you have combined ratios, one part of the equation comes from the income statement and one part comes from the balance sheet. You need to know this because this is how you're going to find out how to solve these problems. So if we go to page 269 in the Builder's Guide to Accounting here, you're going to see a complete list of the ratios that they might ask you on the exam. We have 3 types of ratios. We have income statement ratios. Both part of your ratios of the problem come from the income statement. You have balance sheet ratios. Both parts of the ratio come from your balance sheet. You have combined ratios where you have to find one part of the ratio in an income statement and the other part's in the balance sheet. You go to page 273 in Builder's Guide to Accounting, and there's a list of all the ratios that they might use on the exam. And at the top heading of each one of those, it tells you whether it's a balance sheet ratio, a combined ratio, or an income account ratio, okay? So you might not remember this when you're taking the exam, but if you go to page 273, you look up the type of ratio they're asking you about, you figure out where am I going to find this information. Then you're going to turn to the back of the Builder's Guide to Accounting to a section called Johnson Construction, and you're going to use their financial statements as your model so you can remember how to do this, okay? This is like a shortcut. You're using everything right out of the book, so you don't really have to understand what this is all about. All you have to understand how to solve the problem. You come to page 273, you look down here, find your ratio. It tells you where the parts are. You go back to the back of the book, Johnson Construction Company, and you match up the income categories that they've referred to, and then you solve the problem they gave you on the exam. The next we have balance sheet ratios, which are current ratio, the quick assets ratio, the owner's investment versus creditors, ability to meet obligations, working capital ratio, owner's financing versus debt financing. Income statement ratios are typically percentage of gross profit ratio, your expense control ratio, margin of profit. Combined ratios, which are very common, are your trend in charge sales, real turnover of your assets, days of inventory available, true investment yield. The next thing is cash budgeting methods. You have the cash movement method and the sources and applications of funds method. What these two methods ask you is how you're going to handle cash in your business. The cash movement method means budgeting for the flow of actual cash in and out of the business. It's a cash method. You're going to deal with actual money that goes in and out of the business. This is cash basis accounting. Sources and applications of fund method. This method assumes an operating budget and then subtracts expenses from the budgeted cash flow to calculate the level of available capital. So you begin with an assumed amount of money, such as your contract amount. Let's say you got a contract for $200,000 and you begin with this operating budget of $200,000, and then you start subtracting your expenses from this budget. Now you may or may not have $200,000 in the bank, okay? So this is a more tricky way of doing business, but it's much more accurate. It's a much more accurate way of determining how much money you're making on each job. For the little guy, for the small contractor, typically you're going to use cash budgeting. You're not going to use accrual accounting because it takes too much time. You'd have to hire an accountant to do all your work for you. And the next thing is reserve for bad debts. Reserve for bad debts is a realization that some people are not going to pay you, and your company must not depend upon cash that will never materialize. So for that reason, you need to establish a reserve for bad debt. Anytime you extend credit, some percentage of people are either going to pay late or not pay you at all. And so if you're counting on that money coming in by the 5th of the month or the 1st of the month to pay your bills, you're going to end up in trouble. And this is something that happens to contractors a lot. They run out of money, and then they start taking money out of another account to pay for a job that's half finished or something like this. And once you start doing that, you're lost. And it's also against the law, and they can fine you up to $100,000 for doing that. So you've got to be very careful in dealing with cash and cash amounts of money. With the reserve for bad debt, you want to recognize that late paying customer, you want to recognize a late paying customer so that you can hold them to a payment schedule. In other words, the sooner you figure out somebody's paying you late, the sooner you get with them and say, all right, how are we going to deal with this? You know, come to some sort of terms with it. Stay on top of them, the more likely it is you're going to get paid. And that's what they tell you in the Builder's Guide to Accounting. Okay, writing off bad debts. Now, for the IRS, bad debts can only be written off when the debtor abandons the business. The debtor cannot be contacted. They move out of town, they're gone, you can't find them. Or when they die and leave a worthless estate. What this means, if, let's say, $100,000 worth of work for somebody, they don't pay you. You can't write that off as a bad loss unless one of these three conditions are true. That the person goes broke and you can't find them, and they die and have a worthless estate. Some combination there. So that you can say there's no way I'm going to collect this money. As long as there's a possibility that you can collect the money, the IRS is not going to allow you to write that off your books. Okay? And you want to write it off because once you realize you've got a bad debt, you don't want to recognize that as income. You certainly don't want to pay taxes on something you're never going to collect. Okay, your bad debt ratio. is total credit sales divided